as is usual at the start of a month, the latest jobs figures from America will dominate the attention of markets, not forgetting that of economists, politicians and central bankers. The week will start with the Job Openings and Labour Turnover Survey, or JOLTS, on Tuesday the 3rd of October, and that'll be followed in quick succession by the ADP Payroll Survey on Wednesday the 4th, weekly initial unemployment claims and Challenger Grain Christmas Job Losses Survey on the 5th. The week will then end with the US government's official non-farm payroll survey on Friday the 6th of October, when the Bureau of Labour Statistics will also release the latest unemployment rate and wage growth numbers. So by wage comparison, the numbers for August looked as follows. America added 187,000 jobs. That was below the 12-month average run rate of 245,000. Also watch not just for the headline number, but the revisions to the previous 2 months. July's figure, for example, was 157,000. Now, the final net revision has been downward for every month so far in 2023. That's often seen as a harbinger of a slowdown or recession, just as upgrades are seen as a positive sign. As to the other headline figures, well, the unemployment rate was 3.8%, still near historic lows, albeit a fraction above January and April's reading of 3.4%, and that was basically the lowest ever. And also, thanks to that tight labour market, the average American hourly wage grew to $33.82 in August, and that was 4.3% higher than the year before. Now, this all matters because some economists are still worried about recession in America, although they're now in the minority, and the financial markets seem to think that the US Federal Reserve could keep interest rates higher for longer in response to ongoing economic strength. On the home front, there's a select list of companies that are scheduled to release first half or full year results or a trading update, and only a couple of FTSE 100 members are due to say something. Names which nevertheless may be worthy of further research include the following, although some of these dates could yet still be subject to change. James Halstead on Monday the 2nd of October, Greggs, Boohoo, S&U and Gooch and Housego on the 3rd, Topps Tiles on the 4th, Imperial Brands, Pennon, Virtue Motors and Ferrexpo on the 5th, and to round out the week, Pubs Group JD Wetherspoon on Friday the 6th. But the company that could just cause the biggest fuss in the week ahead is Tesco. The supermarket giant is slated to release its first half results for the 6 months at the end of August on Wednesday the 4th of October. Now, shares of the FTSE 100 member are up by a fifth over the past year. That may irk those who think the company is profiteering during a time of inflation, and please others who simply view it as a sign of how strong the company's competitive position still is, despite the number of rivals who continue to snap at its heels. And the grocery market is competitive. According to Kantar World Panel, the discounters Aldi and Lidl continue to gobble up market share, but Tesco has managed to increase its share of the pie all the same, to 27.2% from 26.9% a year ago, although that figure is broadly unchanged from where it was in September 21. Tesco does also face higher bills of its own, such as utilities and wages, and the firm may well be looking to compensate for those costs with higher prices, while still providing value for its customers, and the firm does take pains to stress its price match and club card offers. This is a tricky balancing act. We all have to eat, drink, and keep our houses clean, but at the same time we may buy less or at least trade down through brands when times get tough. Analysts and shareholders will therefore study the Tesco statement very carefully for comments on input costs and pricing and margin strategies, as well as looking out for how they may be impacting the reported numbers. And when it comes to these first half results, analysts and investors will look for 4 key data sets. The first is like-for-like sales growth in the second quarter and the first half overall. At the first quarter stage, group like-for-like sales were up 8.2% year-on-year. Now, the UK was up 9%, wholesale business booker was up 8.4%, and Central Europe was just up a little bit by around 1%. Online sales rose 8.2%. Now, the second figure is operating profit. Alongside April's results for fiscal 2023, Chief Executive Ken Murphy offered a forecast of broadly flat adjusted operating profit from the retail arm of £2.5 billion, with Tesco Bank expected to add another £130 to £160 million, again, broadly flat. For the whole year, therefore, analysts looking for £2.7 billion in adjusted operating profit against £2.6 billion, and in the first half last year, Tesco generated adjusted operating profit of £1.3 billion. just over £1.2 billion from retail and £67 million from the bank. So they're the benchmark figures for this set of interims. The third figure to watch for is operating free cash flow, where Tesco has a target of generating between £1.4 and £1.8 billion. And the fourth is cash returns to shareholders. Tesco is currently running a £750 million buyback to add to the £1.05 billion return via this mechanism since April 2021. The firm does also pay a dividend. Analysts are looking for an unchanged payment of 10.9p a share for the whole year, so that implies a flat figure of 3.9p in the first half. Hope that you and your families are in good health and good spirits. Thank you for watching, and I look forward to seeing you again next time.